Hey everyone, welcome back to Fiscal Voyage. It's Felix, and today we're going to talk about three different REITs, and all three of them are retail REITs with high dividend yields of over 5%. And I actually own all three and would like to buy more, but I would like to little pullback. But if you are starting out, so maybe now is definitely a good time to open a new position. So we're going to cover these three stocks right now. So the first one we have here is, I'm sure you guys are aware of, Realty Income Corp, ticker symbol O. Right now, as you can see here from yesterday closing price, is going at $52.44. And you can see here over the max time frame here, the company for the most part tend to have a normal PE of 17.48, and this is based on the adjusted funds of operation, or FFO, over here on fast graph. And you can see here, for the most part, this company tends to be overvalued most of this time. And then now, based on the historic data, we have a great opportunity to buy shares around the $52, $50 mark that's undervalued. Now, if we shorten this time period, we can see here, if it were to revert back to its normal PE around 18 over the past 10 years, or more like 7 years, you can see here, you could have a potential annual rate of return of 22%, over 22%. The company is A- credit rating, which is outstanding, only 36.9% debt to cap ratio, and the dividend yield, as you can see here, 5.88. And speaking of the dividends, if we go to performance here, you can see the company over the past, let's max this out, since 2007, it's been increasing dividends since then, and been paying monthly dividends as well. But the growth has been decreasing. You can see here in 08, 09, it was less than a percentage, but then it really picked up after 2013 here at 21%, but then it was 5-6%. Normally high yield companies tend to increase dividends at a lower pace, but you get the high yield right now. And since we're getting the high yield, we're also getting a undervalued and a great yield, because if we go to the historic yield, you can see here, most of the time this company normally average around 4% to 3% in dividends. And so now we're getting a 5.88, almost 6%. So that's great. And we also look at Morningstar. They have a fair value price at $76. And you can see here, $52 is the last price. So $76. So it's very undervalued based on Morningstar, based on fast graph. So you have a great potential for return. And even if it didn't return back to the 18 multiple, if we go back to 15 multiple compared to the 7 multiple it is now, you have almost 14% annual rate of return. And while you wait, you're collecting almost 6% dividend yield that increases year after year. And the best part also, the dividend is safe. And you can see here, based on the payout ratio, next year payout ratio is around 74%, which is real good for a REIT. You like to see REITs 60, 70%, 80%, really no more than 85. 80 to 90% is really where it's kind of good, getting shaky or concerned. But for the most part, there's a great dividend at this, is covered, and a great yield. And the next company we're going to talk about is ADC, ticker symbol. Hold on, put that wrong. Agree Realty Corp. And this one's another one that's undervalued based on the fast graph. And we're going to look at the Morningstar as well. But first, the fast graph. You can see here 5.26 yield. It has adjusted funds from operation yield of over 7%. The normal multiple is 16, whereas currently, the blended PEs right now is at 14, whereas normal multiple is at 16. So it's undervalued based on that. You can see here since 2016, 15, it's been overvalued, and then now it's starting to become undervalued, and it's because of the interest rate increases over the past few years. But once the Fed starts decreasing interest rate, this should be a catalyst to drive the stock higher. And again, if we shorten this time period, you can see here over the past 9 years or so, the company has been growing earnings about 5.6%, which is great for high quality REIT. And if we were to revert back to its normal multiple of 19, we could have almost a 20% annual rate of return for the next 2-3 years. So which is great. It's a BBB plus or BBB credit rating, and it has a low debt to capital ratio of 32.2%. Again, if we go back to performance, and let's put it max here. You can see here the dividend cut was cut in 2011, but ever since then it's been increasing very nicely into low single digits, 5%, 4%, 6%. So that's great. And then we go back to the payout ratio, which is very important for our dividend investors, only at 73.8% based on the 2024 earnings of $4.10 or $4.10 on adjusted fund operation, what analysts are expecting. Now, if we go to fast graph, we can see here it's also undervalued. We have a where's the fair price? Fair price is $68, and right now it's at $56. So we have a, more or less a little more than $10 difference. So you can see there it has a 5-star rating from Morningstar, so it is undervalued. I own it. I actually own both of these companies at a lower price, so I'm up slightly for them. And then the next one is Triple N. It's another one I like and own as well. This one I own it over here. I think I'm on $40. So I'm up slightly. I would like to buy more at 35, but anyway, Triple N and then REIT. You can see here's a triple B plus credit rating, yield over 5.37%, almost 5.4%, and it has a. You can see here the normal PE is around 15, and currently right now the blended PE is at 12. So that right there is another saying that it's undervalued. And if we revert back to the PE, you can see here another 17%. So these REITs could drive around over 15% in annual return for the next few years. So that's great. This is why I own them, under what they currently are. So that's great. I would like to buy more, maybe on a pullback, and we're going to look at the technical analysis shortly. So you can see here, if we go to performance, you can see this one's been growing the dividend as well. Again, all of these three stocks, the dividend growth is not really impressive. It's more for the income, to get the income now, and while you're continue to use that income to build a bigger portfolio and more dividend to income for future. If we look at Morningstar, you can see here this one. Fair value is at $50.39. It also has a 5-star rating, and last close at $41, so almost a $9 difference. So that's why I like all three of these REITs. I own all three of these REITs. Now, if we look at the technical analysis of it, if we can see here, Realty, we're gonna look at the monthly chart. You can see how this stock basically bounces off the 200 moving average on the monthly. So it's possible that it could come back. I doubt it. I think it's creating what is called a buy setup. So if it gets over this $53, $54, it looks like that's the low here. So then it's going to convert from a lower high, lower low, lower high, lower low, lower high, and then higher low. So that's going to create drive momentum. The buyers are stepping up. So I was picking up shares around this price because it hit the 200 moving average on the monthly chart, which is a great buying opportunity. But right now it's still a good price to buy shares if you don't have, or if you want to add more to it. It's definitely a good time to add more. But I want to wait maybe for like a market pullback, because the market has been up since November. So I'll wait for something like that. If we go to ADC, same thing here. This has room to the 200 moving average around $44, $45, or $40 in that range. If it comes down here, I'm definitely gonna be buying more, because over here we have plenty of support here in the $45 range. But also this was resistance, so this could be support. So this is why it bounced here and it came back here again. So it's possible that it could bounce here because what was the ceiling now becomes the floor. So it might find support in this $50 range. But still, as you saw, it is undervalued based on Fast Graph and Morningstar. So still at this price is a great opportunity to pick up more shares at a great yield. But if we have a nice little correction in the market, it should bring it down to mid 40s, and that'd be definitely a time to be buying shares. And then if we look at Triple N over here, at the moving average, you see how beautifully it bounced on the monthly moving average, the 200. You got it over here in 08, 09, over here during COVID, and then recently a few months ago. The great buying opportunity around the $35. And then you can see right where the line is right here, this $35 to $34 is great support area right there. And then the next support, if it crashes, I'm buying more in this COVID low, right? But if it does come back in the $36, $35 range, I will be buying some more shares. But right now it looks like it created a higher low. So it looks like if it gets over these moving averages here, it should continue higher. And then the next resistance point is this $48 to $50 range where it could struggle. But if it breaks that, forget it, it's gonna go to the all-time highs around $60. So those are the three retail REITs that I own and really like at today's prices. They're still undervalued. I think they're a great opportunity. They all have a high yield of over 5%. Continue to grow the dividends, and once the Fed start decreasing rates, I think these going to drive these prices, these utilities and REITs even higher. So those are the three I like right now, and there's a few others. Maybe in the next video we could talk about those. But in the comment, let me know which one, if you own any of those three, or you own all three, or you don't, or plan on owning. Let me know in the comments, and we have a nice little discussion. Thanks again. Make sure to subscribe and hit like on the video. Thanks. Bye.